Let's be real for a second. Have you ever jumped into a gold trade, watched the price move just a tiny bit, and then stared in total shock as your account balance just craters by hundreds of dollars? Yeah, it's a painful and super common experience. But what if I told you there's a simple little hack to stop that from ever happening again? One that lets you calculate your risk on gold in like 3 seconds flat? Okay, let's get into it.
So why is gold the account killer for so many traders, especially when they're starting out? I mean, everyone wants to trade it because it moves so fast and the profit potential is huge, right? But that volatility, man, it's a massive double-edged sword. And the reason people get cut isn't their strategy. It's something way, way more basic. And this is the brutal, honest truth. So many promising traders get completely wiped out by gold before they even have a chance to figure things out. The stakes are just incredibly high, but the reason why might actually surprise you. It has nothing to do with being a perfect market wizard. It's all about avoiding something I call the beginner's gold trap. And this entire trap is built on one simple fundamental misunderstanding of how you even measure a move in gold. That's right, your entire strategy, your analysis, your chart reading, your entry signals, it can all be totally on point. But if you're making this one little calculation error that almost everyone makes at first, none of it matters. You're basically set up to lose from the very beginning. And here's the absolute heart of the issue. Gold, or XAUUSD, does not act like a normal currency pair, like the euro/dollar. It's a different beast entirely. So if you try to apply the same rules for calculating your pips and your risk, you are literally walking straight into a financial trap. Which brings us to the core of the problem. All this confusion, all this lost money, it all boils down to how we read the numbers on the screen, and specifically where we're looking for that little decimal point. Okay, look at this. It lays out the whole problem perfectly. On the left, with currency pairs, we're all trained to look at that 4th decimal place. That's our pip. Simple. But then you look over at gold on the right, and if you use that same logic, you are miscalculating your risk by a factor of 10. It's a completely different system. But here's the good news. Don't worry, because the solution to this is so simple. It's a little trick I call the 1 decimal hack, and it's about to make this entire problem just disappear. So here's exactly what you do. First, just open up your chart. I always use TradingView for this, it's perfect. Find that little ruler icon, the measure tool. Now, just click where you plan to enter the trade and drag it down to where your stop loss is gonna be. The tool will then pop up with a number. And let's say, for this example, the tool shows you this number, 919. Now, a beginner's brain immediately sees that and thinks, whoa, that's 919 pips, which would be an absolutely insane amount of risk. But that is totally wrong.
And here it is, the big secret. Whatever number that measure tool gives you for gold, you just move the decimal point one single place to the left. That's it. That is the entire hack. So, that scary number, 919, instantly becomes 91.9 pips. See how easy that was? You just went from a number that would make you panic to the actual, manageable number of pips you're risking on your trade. It's that simple. Let's just fire off a couple more real quick so this sticks in your brain. If the tool shows you 150, you just move the decimal and it's 15 pips. If it shows 500, it becomes 50 pips. It works every single time, no exceptions.
Okay, so why does getting this one little calculation right matter so much? It's a cool trick, but why is it a game changer? Well, because knowing your pips accurately is the absolute first step to managing your money and, actually making a profit.
It all connects back to the most important rule in all of trading, the 1% rule. This is the idea that you should never ever risk more than 1 or 2% of your account on a single trade. This rule is what keeps you alive in the market, but you can't follow it if you can't calculate your risk in the first place. And just look at the damage this mistake does to your wallet. It's insane. If you made the mistake and thought you were risking 919 pips with a pretty standard lot size, you'd be on the hook for over $900. But by using the hack, you see the real risk is about $92. That is literally the difference between a small, acceptable loss and blowing up your entire account on one trade.
And you've got to be able to do this math instantly. The market doesn't pause for you. When things get crazy, like during the New York session, gold can move like lightning. This hack lets you know your exact risk in your head, right on the spot.
So let's bring it all home. This isn't really about a clever math trick. It's about taking back control. It's about you achieving true mastery over your risk.
Because look, at the end of the day, a long trading career isn't built on finding one perfect winning trade. It's built on surviving. And proper risk management, which is only possible with accurate calculations like this, is the #1 thing that will get you through your first 6 months and beyond.
So the takeaway here is really simple. Stop guessing what you're risking on gold. Stop leaving it up to chance. Take control, start calculating with confidence. This one simple hack literally removes one of the biggest and most expensive hurdles for new traders. It gives you clarity. It lets you manage your trades like a pro. So the only question left is, now that you can calculate your risk perfectly, what kind of trading career are you going to build?